Hello everyone. Welcome to today's webinar, hosted by our Exness FMS team. We are diving into a fascinating topic that uh, blends simplicity with effectiveness, the Heikin Ashi trading system. This is a Japanese charting technique that has quietly but steadily gained popularity among a lot of traders who want a clear view of the market. So this session is designed to be very comprehensive and very practical, and we will cover the core concept of this signals, this strategy, and look at its formula and how it differs from standard candlesticks, and then dive into actual strategies and applications in trading. And at the end of the session, we will choose some of the instruments that gave us a lot of volatility for this week, and we will do some kind of technical analysis to you. Before we start the session, I would like to notice some of our disclaimer that this presentation is for information purposes only, and any information relating to the investments should not be considered as advice or endorsements. And any point of view is the presenter's personal opinion only and does not reflect the views of Exness. Okay, so here is today's webinar agenda. First, we will look over the definition of Heikin Ashi and where it origins and what kinds of information does this signal gives us. And secondly, we will move on to the strategy part and how we can generate the strategy to maximize our trading portfolio. And lastly, we will apply this strategy to our real trading system and digest some of the technical analysis with it. So let's dive into the definitions of Heikin Ashi strategy. Uh, the term itself comes from Japanese and translates to average bar. And unlike standard candlesticks that reflect pure price action at the given time, Higurashi modifies the way candles are formed by taking into account the previous bar's open and close. And this results in a chart that's much smoother and easier to interpret. And here's a practical way to think about it. Imagine you are driving through a bumpy road. A normal candlestick chart shows every single bump, every twist, and every pothole. But Haikunashi is like driving the same road in a luxury car with a very nice suspension. And the journey feels much smoother, and the direction is much clearer, and you are less likely to panic from every little jolt. And this smoothing effect is what makes Iconashis especially valuable in trend following strategies. You can more easily identify when trend starts, when it weakens, and when it might be reversing. And psychologically, it helps you stay in the trade much longer instead of exiting too early just because of some kind of minor price fluctuations or volatilities. So a lot of traders make the mistakes of treating all candlestick techniques the same. But once you get comfortable with Heikin, you will start to notice how much more confident your decision making becomes, especially when markets gets a lot of volatility. So keep this core idea in mind as we move forward. And Heikin is not just about simplification, and it's about much more about the clarity and controlling your psychology and controlling your trading. Now let's break down the logic behind the Heikin candlestick. Right? Instead of just taking the current price data to form a candle, Hakanashi uses some kind of special formula, as you can see from here. That sounds a bit technical at first, but let me explain why it is important and why it matters. And this formula is what gives Heikin-Ashi is smoothing effect compared to the normal uh, the normal price formula. And you are not just reacting to raw price movements, you are filtering them and softening the edges and seeing the trend more clearly. So while the formula may seem like a technical detail, it's actually the foundation for why Hakunashi works. And once you understand this, you can start building real strategies on top of it. So this is the formula of Heikin Ashi, and you can easily find when you search for the Google. So if you are interested in like finding new formula or finding new strategies related to the Heikin Ashi, just search Heikin Ashi in the Google and just get into the formula and learn about it. And let's take a moment to a, visually compare a regular candlestick chart with a Fibonacci chart. On the left, you see a typical open, high, low, close chart. It's like raw data. Uh, it looks accurate, but often it looks very messy. And price bounces up and down, and colors alternate frequently. And for many traders, it's easy to get confused a lot. And especially in choppy markets, this type of chart can lead to emotional trading, entering and exiting positions too quickly, or misjudging trend strength. Now, look at the right side with the colors, the Heikin-Ashi charts. Notice how much cleaner it looks compared to the left one. So trends are more continuous and color changes are less frequent. And this is not just aesthetic, and it has a real psychological effect. And traders are emotional creatures, and what we see on the chart influences how we feel and act. And Haikunashi helps you to stay grounded. And let me give you a practical example one more time. And imagine you are in a long position and price starts to drop a little on a regular chart, as you can see from here in the left. You see a red candle, you panic a bit and close your positions too early. But in the Hibonacci chart on the right, that kind of same pullback might not even turn the candle red, and it could just create a small wick uh, while the body stays blue. And that's your cue to stay in the trade because the broader trend is still intact. Of course, Hakunashi is not meant to replace regular candlesticks. It's meant to like complement each other, complement the regular candlesticks. So use the smoothness of Hakunashi to follow the trend and the sharpness of standard candles for entry precision. So the takeaway here it is, Aikanashi simplifies the visual landscape of your charts. It helps you make clearer, calmer decisions, especially when there is a lot of volatility in the market. So based on what we learned about the definitions of Haikunashi itself, we will look into how we can generate these Haikunashi strategies. Now that we understand how Haginashi candles are formed and what they look like, let's talk about the strategy. And at the core of the Haginashi trading approach are two simple but powerful concepts, color and pattern. And together they form a foundation for most trend-based decisions. First, let's talk about the color. In most platforms, blue or green candles represent bullish movements, while red indicates the bearish movements. The beauty here is that as long as you are seeing consecutive candles of the same color, especially with no wicks on the opposite side, we're likely in a strong trend. So the rule of thumb is simple: trade in the direction of the color until the color changes. And second, we have pattern. And you might be wondering, do traditional candlesticks pattern like a hammer, doji, or engulfing patterns still apply? The answer is yes, but with a little bit of a twist, because Hakunashi is much smoother. Patterns tend to appear with more clarity, but also with a slight delay with it. And that's actually a good thing for you because you are trading confirmed momentum, not reacting to random volatility. For example, a series of small-bodied candle with long upper and lower wicks might indicate indecision, a potential turning point. And if followed by a strong red or blue candle, that could be your confirmation signal. In a moment, we will dive deeper into each strategy and also talk about some limitations because, as with any tool, knowing when not to use it is just as very important as it is. Let's zoom in a little on the concept of patterns in Hikinashi because this is where we can really start applying what we know about price action. Traditional candlestick patterns such as doji, morning stars, or engulfing or hammer patterns still hold meaning here. But since Heikin uses average data, the way these patterns show up is slightly different. The edges are smoother and the signals tends to be more confirmed, meaning they are less noisy, but also a bit slower to appear on the charts. So what's the benefit of it? Well, think about how many times you have seen a reversal pattern form on a regular candlestick chart. But with Heikin those false signals are reduced, and especially when you pair them with color confirmation. You can see one example here. Traditional hammer patterns, you can see here traditional hammer patterns might signal a reversal on normal chart, but with Heikin that same reversal might appear as a series of shrinking the red candles followed by a strong blue one with no lower wick. Uh, that's a stronger confirmation, and you can act on it with more confidence. And another advantage is the ability to spot some kind of consolidation zones. And when you see several candles with small bodies and wicks on both ends, it usually means the market is taking a breath and it is waiting for the direction actually. And that's your opportunity to prepare either for a breakout or to avoid getting caught in the sideways actions. But just like any pattern-based strategy, context is a critical key. So as a trader, always ask yourself, is this pattern appearing in a trend? Or are we at a support or resistance level, or are we trading with or against the overall directions? The Hakunashi doesn't eliminate the need for the judgment, but it does help you apply that judgment more consistently and with less noise. Now, let's focus on one of the simplest yet the most powerful aspects of Heikin trading, color-based decisions. When you look at a Heikin chart, you will typically see just two main colors, blue or green for bullish and red for bearish. And instead of reacting to every price twitch, you are following a broader moment confirmed by consistent candle color. And here's the rule. When you see a sequence of blue candles with little to no lower wick, you are in a strong uptrend. And conversely, a string of red candles without upper wicks usually signals a strong downtrend. And let me give you one more examples and one more scenario. Say you are trading euro dollar and you see three consecutive red Hakinashi candles forming on the 1 hour charts, all with no upper wicks. And that's a high probability short opportunity. But instead of jumping it impulsively, you wait for the next candle to close. And if it maintains the same structure, you can enter. And why wait for the close? Because mid candle, the market can still reverse on Heikin Ashi candle forming. Now, what if the color starts alternating? I mean, the colors are changing, blue, red, back and forth, and that usually indicates sideways movements or indecision. And in those cases, the system is telling you something very important. You can stay out, stay out. No system works well in all conditions, and this is where Harkanashi tells you out loud and clear that it is not the time to trade. But no trading system is perfect, and Heikin there is no exceptions with this kind of concepts. While this technique excels in trending market, it has clear weaknesses you need to understand before you can adopt these strategies into your trading. First up, narrow ranges, and when the market is moving sideways or consolidating, Hibonacci candles can become they can give some kind of misleading signals. And you will see alternating colors, fake signals, or tiny candles with long wicks. And if you are not careful, you will end up entering just before price snaps back the other way. The second, the cost problem, especially for intraday traders using lower time frames, and transaction costs like spreads and commissions add up to this. And in tight non-trading conditions, even if your setups looks good, the movement might not be strong enough to cover those costs. And it will be very frustrating, and it's something you must factor in when you do your real trading. Third, there is some kind of lag, as I told you previously. Because of its averaging formula that we have learned so far, Hakunashi reacts more slowly than the traditional candlesticks. And that's great for confirmation, of course, but it also means you might get in late, or you might get late in exit after a reversal has already started. So, if you remember one thing from this slide, Heikin is a very nice and fantastic tool, but only when used wisely and in the right context. So don't expect it to save you from choppy markets or some kind of poor trading planning and the trading without the risk management. Lastly, let's look at how we can upgrade the Hibonacci system to overcome the limitation we just talked about. The first way is by adding the oscillators. As you might already know, tools like RSI, stochastics, or MACD help you confirm whether the market is overbought, oversold, or just lacking momentum. Uh, for example, if you see a Heikin bullish trend, but RSI is showing divergence, that's a red flag. And it tells you the trend may be weakening from now on. And second, use the trend following indicators like moving averages or super trend. And this help you stay in the trade much longer and avoid some kind of premature exits. And also think about applying some kind of time frame filters. And what looks like a breakout on a 5-minute chart might be noise on the 1 hour charts. So always check the higher time frames to validate your setups. And like I said, always bring it back to the risk management. Risk management is always important. uh, Even the best filters and indicators won't protect if you are over leveraged or not using a stop loss. So trading is a game of probabilities, and the best we can do is tilt the odds in our favor. So please look over all the information that I gave you regarding the Heikin Ashi, and please pay attention to these improvements and of course, with the risk management, and this will save your portfolio and it will give a lot of chance and probabilities to for you to stay longer in the games. Okay, I think this is all I got, and from now on, Xing will take you to the adopting the strategies into the real charts, and also she will introduce some of the technical analysis with the hot potatoes on the market. Thank you.
Thank you, Inki. Let me share my screen, right? So the next part we will be covering on how we can apply this Heikin Ashi strategy, as well as looking at a few chart examples. We will take a look at gold. If you guys have any other chart requests that you would like us to just do a back test of this strategy on, right? Please feel free to share them as well. Okay, so let me just share my screen. Just give me a moment. Okay, I hope that you can see my screen. Right, so the next part we will be covering would be on application and trading Heikin Ashi. Right, so first we will take a look at the different parameters. Right, if you guys can't see my screen or if there's some technical issues, please just raise it up in the chat. Okay, you can put your questions or any comments that you have under the chat box, and we'll take a look at that. Just give me a moment while I make it full screen. Okay, so right now let's take a look at a few parameters for Heikin Ashi. Right, first thing first, right, understand that uh this whole format or this whole Heikin Ashi candlestick, right? It's a measure of trend. So like what Inki mentioned, it has to be in a trending market, right? If markets are choppy or if it's moving sideways, and that's when we will get a lot of false signals. So that's one. The other thing to consider is that instead of just hopping into any charts, right, be it on the 1 hour, 4 hours, or 15 minutes, and just going through the Heikin Ashi strategy as it is, we have to bear in mind that as with every analysis, right, especially from a technical analysis, always bear in mind what the higher time frame is trying to tell you, right? Are there key levels that prices are testing, right? Is it sitting on a support or resistance levels? Because that would frame the lower time frames direction. So it's important to understand, right? And of course, analyze the bigger picture. So this is what we mean, right? When we talk about analyzing the bigger picture, really understanding, if we are seeing any kind of liquidity that's being taken out on a higher time frame, and where could prices go next. And then using that idea, right, we try and identify on the lower time frames if there are trend that's telling us that price could continue trending in that same direction. So that's the framework, right? And the second part, it's determining the volatility, right? So this is really dependent on the instruments, right? So some instruments might be more volatile, whereas for the other instruments, less volatile, right? So a lot of this is dependent on that instrument. So right now we are just presenting certain things that we need to keep in mind, and then following that, right, we will adopt all of this, right, and we'll apply that on the chart on the charts. Okay, and then the last one, it's of course, right, understanding. So once we have understood the bigger time frames narrative, right, we also determine the volatility. So how wide potentially are the stop losses. The third part is to trade in the smaller time frames. Now, the reason why trading in the smaller time frames would be helpful, it's because on the smaller time frame, right, especially if you are taking entry just based on a specific candle, smaller time frames generally mean that you can keep your stop losses slightly tighter as well, right? So just based on lower time frames market structure. So while it's a new concept, right, introducing this Heikin Ashi strategy, but at the same time, the idea behind how it works, how trend works, right, when market is in an uptrend, we look at higher lows and higher highs, right? And then if it's a downtrend, we look at lower lows and lower highs. So those concepts are still the same, right? They might be shown differently through the Heikin Ashi candlesticks, but the idea is the same, right? So just a quick recap for those of you guys who are not familiar with it. We talk about higher lows and higher highs in an uptrend, right? And because of that, if prices continues in an uptrend, we see that the lows in general should not be broken. Now, the converse is true if we see lower lows and lower highs, markets are in a downtrend, right? If the downtrend persists, we should not see the high being taken out. Now, with that logic, right, you will see how it applies on the Heikin Ashi candlestick in a moment. Okay, but just bear with this, right? Keep this in mind that in an uptrend, generally, right, we should not be seeing price violate or break below the low. And the converse is true. If the trend is ending, right, and we're seeing that change in market structure, we could see that break and then lower lows and lower highs being formed. And this concept, right, you can actually see it apply across different asset classes, not just in FX, but also in stock markets, right? So now with that, right, let's take a look at our next slide. So the next slide that we have, right, once we have identified the general framework behind how we can approach this Heikin Ashi, the next step is to take a look at the bigger picture. Right, so for this chart, right, before we go on and share our views on it, we would like to hear what are you guys thought on it, right? So if you are presented this chart, so this is Go daily chart, right? So let's say if I presented a chart like this, what are the things that you would look at, right? So just so that we can better understand how you analyze a chart. Right, so if you guys don't mind, right, just feel free to type your response in the chat, right, in the Zoom chat, under the questions, the Q&A chat or the chat box, right? So just if you are presented this chart, how would you go about analyzing it, right? What are the steps that you'll take? You can also share, if you guys have any indicators that you are using or any specific way that you are analyzing the markets, right? So I'll just leave this chart here for about 1 to 2 minutes. So if you guys can just share, what are your approach, because this would be very helpful in helping us to understand how do you guys analyze that chart and where are areas or gaps that, we could further explain just so that we can improve that understanding. Okay, so I'm just gonna put this here for about 1 to 2 minutes, right? Just feel free to type your response in the chat. Basically, the question is, if you're presented this chart, how would you approach it? How would you analyze it? What will you look at? Do you go with support resistance? You turn on certain indicators, right? Please feel free to share and put them in the response chat. Okay, so I'll just give it about 1 minute, right? If you guys have no questions, right, or if you guys have no clue as to how to approach this, right, that's fine as well. Just, anything you have in mind, you can just put in the webinar chat. Okay, so this is Go on the daily time frame, right? I will also share my thought process on how I approach this, and let's see if this is something that you guys use as well. Right, so in general, right, just a brief one. You can see here, right, on the daily time frame, generally prices are in an uptrend, right? We can observe this from the bullish market structure that we saw. And bullish market structure, it's really by just identifying the swing points, right? So for those of you guys who are not familiar with swing points, right, swing points basically just means the highest and lowest points that we have, right? And we see markets oscillating around. So these are the swing points. You can see higher lows and higher highs, right? This is a small consolidation before a further move to the upside, right? And then we're seeing that shift here. So you can see that prices are generally in an uptrend. You observe the higher lows and higher highs that's being seen over here, right? And then what's interesting to note is that we have this deeper retracement, right? A move to the downside. Now, this move can suggest two things, right? If along the way we're seeing clearer lower swings being formed, right, then it suggests an end to a trend. But now that we're seeing the initial move to the downside, right, it's interesting to also highlight, right, for those of you guys who are more familiar with the concept of liquidity grab, right, the idea that price could just move slightly beyond a support level before it continues to the upside. Right, so this is something to bear in mind as well. So of course, we are not just looking at one time frame, we're looking at different time frames, right? Starting from our higher time frames down. But just looking at this specific chart, you can see that this would be my thought process, right? So if prices are forming higher lows and higher highs, and we're seeing a sweep of this move, right? If I want to see that bearish trend continue to the downside, first I want to see bearish fair value gap being respected. You can see this is a bearish fair value gap that we have over here. It's also a previous support and resistance level. We saw that bounce to the downside before price pushed higher, a break of the last low, right? So if price does push back and respect this area, we could see potential consolidation. At the same time, right, if we do see a move to the upside, then we could target this high, which is also the buy side liquidity, right? Or resistance level, if you would like to call that. Right, so that's the general idea. Now, how do we transition this, right? And how do we actually apply Heikin Ashi on it? Right, so notice we talk about how Heikin Ashi is a trend following indicator, right? We mentioned that in general, because of that smoothing effect that it gives, it can be lagging, right? That's just similar idea to how moving averages work. You can see that while it's a trend following indicator, it can be slightly slower in terms of identifying a trend reversal, because you need price to move significantly to the downside, right, for your moving average to tilt downwards. So that's the idea, right? So likewise with a Heikin Ashi candlestick, right? If we take a look at a strong uptrend, you can see constant bullish candles being formed. But if we do see that trend reversal, right, we will take slightly more for price to pan out before we see that bearish I guess signal, right, on Heikin Ashi. Okay, so this is an example, right? So we talk about fair value gap, we talk about supply, right? So the idea that if this is a bearish zone, right, we have a bearish fair value gap, this support and resistance level could act as a potential supply, right? So that's just looking at candlestick patterns. If we take a look at Heikin Ashi, this is where things get interesting, right? So for Heikin Ashi, you can see that the same bullish pattern, it's being shown through this bullish candlesticks, right? Earlier, Inki mentioned that the color of the candlesticks, it's very important, right? Blue just means that prices are trending higher. Red, it's that retracement, right? So notice that when prices are in a very strong uptrend, right, we're seeing this constant blues that were being formed, right, suggesting that uptrend. So let me just annotate this. So you can see here, right, when prices are in that strong uptrend, you can see that this bullish move to the upside, you can see there's hardly or there's no red candlesticks here at all, right? Just signaling that bullish momentum. And then only when we see a deeper retracement to the downside, then we observe this candlesticks kicking in. Right? Likewise, you can see that again over here, the same pattern playing out again and again. Now, with that in mind, right, it's important to note, right, that one way to look at it, right, it's to identify this subsequent bullish candles, right, as potential entries. The reason why it's like this is because think of the market structure example that I gave earlier, right? We talk about prices in an uptrend, right? Higher lows and higher highs. And then when price does a pullback, this pullback, the leg of this pullback on the lower time frames would be bearish, right? So I hope that this is clear. So when we talk about bullish market structure, right? Again, explaining the core concept, higher lows and higher highs. At every retracement point, right? When price starts retracing, on your lower time frame, you would see bearish structure, right? In the forms of lower lows and lower highs, right? So if I were to just elaborate on this a bit more, you can see that this whole move to the downside, you'll see lower lows and lower highs. Now, if price were to continue to the upside, you will first observe that shift in market structure on your lower time frames before it continues forming higher lows and higher highs. And this move that we have on the lower time frames, it would align with the higher time frames bullish leg. It's basically like that. Okay, so with that concept in mind, you can see how this will apply on a Heikin Ashi candlestick, right? Because at this point in time, you can see that when we see that shift in market structure, then that would be that change in color on the Heikin Ashi candlestick. So this higher lows and higher highs, and then that market structure shift that we observe on the lower time frames, and also market structure on normal candlestick patterns, right? On Heikin Ashi candlestick, it would be followed by that color change. So basically, we have a bearish market structure and then followed by consecutive highs, right? So higher lows and higher highs, and then you can see that the color of the candlestick patterns would be blue. So if you want more confirmation in terms of the entries on Heikin Ashi candlestick patterns, what you can do is to wait for a break of the last high here. So using the same concept that we have applied, right? If we see lower lows and lower highs, and we're seeing or we're anticipating for price to move higher, we want to see that high being broken. Because if the downtrend persists, we should not be seeing price break the last high, right? So if we do see a break above the last high, that could be the first indication of a shift in trend, right? And also it could be aligned with the broader market trend, right? If we're anticipating price to be in an upward momentum, then this is what we could be seeing here. So two things. One is that we want to wait for the break in market structure. The second thing is that we want to ensure that we're not entering at the first breakout, right? Instead, you want that trend to be established first before you take a specific entry, right? Targeting the higher time frames resistance. So if you understand this concept, right, then you can understand that just based on the Heikin Ashi, applying similar ideas, here what we have, lower lows and lower highs, right? You can see lower lows and lower highs. We want to wait for price to break above the last candlestick, this bearish candlestick high, that's one. And we want to wait for consecutive blue candles to form. Because consecutive blue candles on the lower time frame would suggest bullish move to the upside, also higher lows and higher highs. Right, so you can see this, right? So when price breaks above that bearish candlestick pattern and it continues to form bullish candlestick pattern, right? You can see, for example, if we're to zoom in, you can enter on, let's say, 2 candlestick, right? Enter on the subsequent candlestick with the stop loss below the low, right? So in terms of the low, it depends on how tight you want to keep your stop losses, right? It can be based on the previous candle's low. It can be based on the previous swing low, right? Even on the Heikin Ashi candle. So a lot of it depends on your risk management because your stop loss level would also determine your profit and your risk to reward ratio, right? Which means that if you keep a tighter stop loss, then this also means that in terms of your risk management, when you want to close out your position, you want to consider keeping your take profit levels slightly tighter, right? It can be based on the volatility, the average true range. It can be based on the next resistance level on the lower time frames, right? So this is really dependent on your trading style, but just floating ideas out there, right? And this area that we have, right, you can see that if your stop loss is based on, let's say, the previous session's high or previous session's low, your take profit is based on previous session's high and low, then this would be more of an intraday trade, right? So in this case, you want to ensure that you're probably okay with keeping a stop loss slightly tighter, right? Because you're managing the position and closing out and taking partial profit much lower. So your take profit target is much lower. Right, so some food for thought. Now, how do we apply that idea or the concept? You can see here, similar idea, right? So if we do see a break, we saw a break of this low, right? So if the bearish move continues to the downside, we should continue to see lower lows and lower highs. Whereas if we do see a rebound, right, then that should show in consecutive bullish Heikin Ashi candlestick, right? So we want to see consecutive blue candles being formed and a clear high, right, which could be a potential target. Okay, so I hope that this is clear so far in terms of how we can analyze or how we can draw parallels between understanding those market structure concepts that we use on normal hollow candlesticks, right? And then apply them like Japanese candlesticks and then apply that same concepts onto this Heikin Ashi candlesticks. The idea is the same, right? Just the Heikin Ashi, it has the smoothing effect, right? Like Inki mentioned, it's able to basically help to filter out some of the noise in the market. But at the same time, because of that, right, it's slightly more lagging. It's slightly more of a lagging confirmation, I guess. Right? Okay, the next thing would be to determine volatility. Right, so before I move on to this, right, just wanted to check in if you guys understand so far what was being covered and if you guys have any questions. So if you guys have any questions, right, please feel free to put them under the chat box. Right, be it questions on either Japanese candlestick or Heikin Ashi candlesticks. Okay, so if there are no questions, we will continue with the next part, which is to determine volatility of the candlestick pattern, right? So for volatility, right, it's important to note that we are using volatility. To determine volatility, right, you want to use it on the Japanese candlesticks, right? So volatility can be identified by using the ATR. ATR is short for average true range. You can use ATR 5, you can use ATR 21, right? Really, the settings is dependent on you. Just bear in mind that if you use a shorter time frame, then it will measure volatility across a shorter period, right? Whereas if you use a longer time frame, then you can see that it would account for a longer period. Okay, so in this example, we used ATR 5 on the daily time frame. So again, this is go chart on the daily time frame. ATR 5 here, right? You can see the ATR is 35. So 35 just means that, on a daily basis, right, the average true range, right, gold moves around $35 a day. Now, why is this helpful? Because ATR can be a simple way for you to identify potential profit, right? So if you are trading, let's say, entering at a specific level, and you're just trading based on the one average true range, so expecting price to move within that one ATR, right? Then you can set your take profit to be $35 away from your entry. Okay, so that's the simple idea in terms of how you can use ATR. But more importantly, right, also understand that while you can use ATR to identify volatility, so if ATR is high, it just means that it's more volatile, right? So if I were to just compare the chart and the ATR, right, you can see here, right, very simply, when ATR is low, you can see that there's hardly any movements, right? Very muted movements that we're seeing. Prices are ranging sideways, right? Whereas if ATR shorts up, you can see that there's this strong move that we're seeing in price, right? And in terms of each candlestick pattern, you're seeing a much wider range that it's covering, right? Which means that the candlestick pattern, the open and close prices are much wider, and each candlestick it's bigger. Compared to here, right, when ATR is low, you can see that we're just seeing mostly dojis, right? Very consolidated muted movements. Okay, so for ATR, right, when ATR is high, it just means that it's more volatile. And this could be driven by news events, right? Especially if we have a high impact news event around the corner, for example, your FOMC meeting, or even just, geopolitical related news events, right? News around Trump's tariffs, for example, right? That could also send volatility higher. So in this case, you can see that ATR on the Japanese candlestick patterns, right, would be slightly more, or it will be a better reflection of the most recent price movement. If you take a look at ATR on Heikin Ashi candlestick, right, it's actually very different, right? The numbers are different because Heikin Ashi itself is already a measure of average, right? It's a average measurement. So when you apply ATR on that, you can see that when prices are trending strongly to the upside, ATR on a Heikin Ashi candlestick would be higher. Okay, so that's something to keep in mind, right? So depending on how conservative you want it to be, in general, I would think that ATR on the Japanese candlestick patterns, or Japanese candlestick itself would be sufficient. Okay, so let's move on to, once we have determined volatility, let's move on to checking the conditions in the desired time frame, right? So in this example, we take a look at, just now we covered the daily time frame, right? So now we're moving on to the 1 hour time frame, and we're taking a look at entering after the close of the first bullish candlestick, right? So you can see here, right, on the 1 hour, right, this is after the daily close. So basically, right, with the idea that once prices are trending strongly to the upside, as observed here, right? So how do I know prices are trending strongly to the upside? Because we are seeing higher lows, right? Higher swings being formed through this, right? So just market structure alone, and even through individual candlesticks. So if you take a look at this Heikin Ashi candlesticks, you can see this subsequent bullish move to the upside, right? And you can observe that as well. And all those red candles in between, right? They are that retracement. It represents that retracement before price move higher. So if you can look at it just in terms of a lens of market structure, you can take a look at it just in terms of individual candlesticks, but understanding that, when prices are forming this bullish candlesticks to the upside on the Japanese candlestick, it just means higher lows and higher highs, right? So with that in mind, right, if we're in that uptrend, and we can track the daily close, right? So once price close and the subsequent candles after the daily close, right, it's bullish, then that candle could be used as a potential entry. right? So you can enter on the range of that candle, right? And then stop loss would be based on the last swing low, right? So depending again on how tight you want to keep the stop losses and your profit target, right? Because that would also affect your risk to reward ratio. So in this case, right, let's say if you want to take an entry just based on the swing low, right? Stop loss can be based on, you can base it on the previous low based on Heikin Ashi candle. Or if you want to keep a much tighter stop loss, you can also explore looking at previous candlesticks low on the Heikin Ashi candlestick, right? Because that would represent the structure on your the last swing low that we have on Japanese candlesticks, right? So with that idea, right? So this is of course understanding that higher time frames direction, right? So which means that we're not suggesting please go into the 1 hour time frame and just identify this pattern, right? Because understand that all this, right, without the higher time frames narrative or higher time frames context, it can be very misleading, choppy as well, right? So the idea is to understand your higher time frame picture, right? Are we seeing any kind of liquidity sweep? And then if we're seeing that, it's trend playing out, right? To show that it is going in the other direction. So simply put, right, if we have a resistance level that prices are testing, are we seeing a sweep of the high and then movement to the downside, right? So if we have that range that price is trading within, let's say a support resistance level, if price starts taking out previous day's high, and we're seeing a movement to the downside, then we want to see this movement that we have to the downside to be accompanied with this bearish trend, right? So red Heikin Ashi candlestick patterns to show that this downtrend is persisting. Then this could suggest a target of the last swing low that we have, right? Where price could sweep this before it continues to the upside. Now, this concept that I've just explained, right, seems very simple, but a lot of it is based on context. The highs and lows, right? Are we identifying them based on daily time frames, weekly time frames, or are we basing it on previous sessions, right? So these are important questions, just depending on your trading style. If you're doing intraday, right, these highs and lows could be based on Asia's high, London's high, New York AM, PM session high. If you're doing it based on more of swing trading, it could be based on previous day's high, previous day's low, right? So these are things, the ideas for you to explore, but understanding that if we do see that liquidity sweep, right, and we see that movement to the downside, we want to see that trend play out. And that trend playing out, it's basically this Heikin Ashi candlestick showing you consecutive red candles to the downside, right? If it's a movement to the upside, then you want to see consecutive blue candles to the upside. Okay, so let's assume that we have all of that part, right? This part that I've just mentioned, the higher time frames context. And once we have that in mind, right, you can see that just observe the lower time frames and try and identify this blue bullish candlestick patterns as potential entries, understanding a potential resistance that price could push into. So, right, maybe if we're to just apply this, right, I'm just going to hop onto the charts later on and see if we're able to apply these concepts, right, and explain and combine all of them. Okay, so now that we have the desired time frame, right, we talk about entry point. So over here, you can see that following the daily close, right, price, we show that bullish momentum to the upside, right? So when price closed, we have this move, right? This can be a potential entry point. So just now I talked about two ways we can identify potential targets, right? One would be based on support resistance levels, right? If you want to trade from the last swing high to swing low, vice versa. The other is based on ATR. We covered that as well. ATR is average true range. It's basically a measure of volatility. So a simple way to put it is that if we have an entry, right, and we have an ATR of, let's say, $35, which means that the probability of price, right, moving or reaching $35, right? If price reaches the ATR, then that's when you might want to close out partial or a certain percentage of your position, right? So that's just purely based on ATR. So not basing it on any support resistance level, just ATR alone. Right, so we talk about determining the exit point, right? There are plenty of exit method, right? One, it's of course if you want to look at a color change of the candle, because the color change of the candle could indicate that price could be retracing. But also bear in mind that for gold, right, because gold it's trending strongly to the upside, right? In this example, you can see that the retracement could be minimal, right? So we're seeing that slight retracement before it moves higher. So this is something to bear in mind, right? Especially when you're in a very strong trending market. So one exit, right, would be to base on the color change, especially when you're in a position. This can be useful for your trading stop. The second one, right, it's just based on risk to reward ratio, right? So entry, stop loss, and then maybe you want to take a 1:2 risk to reward ratio. So 1:2 risk to reward ratio just means that, for example, if I enter at a specific level, right, once price hit 2 times the amount that I risk, I want to get out of the position, right? So it's just based on profit. Right, so this is risk to reward ratio, right? So if for example, if I risk $1, right, when the price hits $2, like when my take profit hits $2 or my profit level hits $2, then that's when I want to get out of the position. It's a 1:2 risk to reward trade. Right, support resistance level, right? Personally, for me, right, I would prefer to use support resistance levels because support resistance levels would give you an idea of where liquidity lies, right? So which is why I think support and resistance levels would be my personal preference. But again, it depends on your trading style, right? And then targeted ATR level, like what we've shared earlier, ATR is just a measure of volatility, right? So if price exceeds that volatility, right, then there's a chance that it could retrace, and that's when you want to get out of the position. So different ways you can actually determine the exit plan. Stop loss levels, right? Stop loss levels, again, depending on your I guess your style of trading, right? It can be based on trailing stop, it can be based on number of pips, right? A fixed number of pips. So for example, if price move by 50 pips, you always want to have your trailing stop 20 pips, which means that once price retrace more than 20 pips, you are out of that position, right? So you're closing out or taking partial profit. It can be based on candlestick patterns, right? But because of a lack of time, we will not cover candlestick patterns today, right? Candlestick patterns can be reversal, bullish, bearish candlestick patterns. This one, it's more of a Japanese candlestick, so we won't cover that for today. Okay, but today's focus is really based on just Heikin Ashi. Right, so as what we have covered earlier, the method looks simple, but it should be used with strict risk management and trending markets, right? We cannot emphasize this enough. Heikin Ashi, because of the nature of the calculation, right, it works well in trending markets, just like a trend following indicator, like a moving average, right? But when prices are trending and sideways, moving sideways, then it can generate a lot of false signals. Right, so with that, right, let's hop on to our charts and show and just go through a few examples, right? I'll just cover mainly on gold. Maybe we can take a look at dollar index as well, right? Since that has been in focus. Excuse me. And if you guys have if you guys have any charts that you want us to take a look at, right, just feel free to put it in the questions chat. Okay, so this is, I'm currently on the Exness web terminal. I hope that you can see my screen. And this is gold's chart. Right, so let me just show how we can actually switch to Heikin Ashi first. Right, so you can see that this is gold chart. This is the time frame. So I'm just going to use the higher time frame, let's say on the daily. And then if you want to switch to Heikin Ashi, you can just change this part. Right, so click on the candle icon, and then you can look at this Heikin Ashi here. So it's at the bottom of this menu. Right, so click on Heikin Ashi and you will see that candlestick pattern change, right? So as we've covered earlier, blue means bullish, right? And then red is bearish. So this is that uptrend. So in a strong trending market, when gold price moves strongly to the upside, that's when you observe strong or consecutive blue candles. Right, I would like to point your attention to this, which is extremely interesting, right? We talk about how Heikin Ashi itself, it's more towards the lagging side, right? It would take a very deep retracement in price for that bearish move to be reflected in a Heikin Ashi candlestick. And this is especially true. Notice this move that we're seeing over here, right? So let me just remove the ATR first. And you can see this move that we have, right? That retracement that we're seeing to the downside, right? You'll see that retracement on Heikin Ashi is just a one red candle. Right? So one red bearish candle. Whereas if I were to shift back to the daily, right? So remember this on the Heikin Ashi, remember that pullback that we're seeing, that retracement. Now, if I were to move back to the Japanese candlestick, you can see that this is hardly just a retracement. In fact, on the Japanese candlestick, right, you're seeing this move, right? You can see that price actually came in and test that demand zone that we have over here, right? So that drop is much larger, right? Or this move that you have, for example, right? That move to the downside, it's much more obvious on the Japanese candlestick as compared to the Heikin Ashi candlesticks. Okay, so that's one thing to keep in mind, right? The second thing to keep in mind is that if you take a look at this general trend, right, on the daily time frame, you can see that prices are still in a bullish move. It's still forming higher lows and higher highs. And if you're to track it just based on the candles alone, you can see that it's the last candle that we have. You can see this move, right? This, we have equal highs over here. Price broke to the upside and then currently is retracing again and testing this demand, right? As a potential demand zone over here, we see that bearish candle. But again, if we do see a deeper retracement, we want to see that bearish candle follow through, right? So I want to see on the lower time frame if we are seeing any kind of deeper retracement or move to the downside. I want to see lower time frames. I want to see this followed by bearish candlesticks. So basically, I want to see consecutive red candles to show me that bearish pressure, right, the move to the downside is still intact. So that's one. Now, if we were to use the same logic, move to your 4 hours time frame, you can see that around the 4 hours, prices are starting to turn. This area over here, right? So just now we talk about daily close, right? So you can see that the daily, right, price, if you observe this move, you can see that here, this candle itself, price did not actually close below the previous candle's low, right? We saw a wick to the downside, but then following that, price actually retreated. We saw that slight bounce, right? And right now it's just hovering between the previous range of the Heikin Ashi candlestick. Okay, so these are all important things to keep in mind. If you take a look at it on the 4 hours time frame, it's interesting to note that on the 4 hours, right, as with every retracement that we saw, you see that red candles, right, to represent that retracement and then followed by subsequent blue candles. And that's the same case here. You can see bearish red candles, right? And then what happens is that we have this move to the downside, and then this, it's the last. So if you track the lower lows and lower highs, you can see that this is the last candle that we have, this range over here, right? That broke the previous low. So this is a potential resistance region that we have, right? And if price breaks above this, followed by subsequent blue candles forming, ideally I want to see the blue candle break above this last high, this area here, right? To suggest that we have that bullish momentum going, right? And on the Japanese candlestick patterns, it's basically forming higher lows and higher highs, right? So you can see that this is an area of consolidation right now that prices are testing this whole zone that we have. And if you observe on the 1 hour time frame, pretty much the same thing, right? So on the 1 hour time frame, what we have over here, it's that you can see that this is the last bullish candlestick that we have. Price continued to form higher lows and higher highs. This move, right? So this is a potential bullish candlestick pattern. And if price continues sitting on this zone, right, we could see a rebound, right? So in terms of the move to the upside, if we do see a bullish momentum following through, right, or this bullish candlesticks continuing, you can target just based on the last high, right? Can just be based on support resistance levels. But on Heikin Ashi candlestick, right, because of the smoothing effect, support resistance levels might be less obvious. So right, you can base it on holo candles, Japanese candlestick, the last high for example, right? Or even this high. Okay. So yep, so that's basically the idea on Heikin Ashi. You can mix it not just based on Heikin Ashi candlestick, but also based it on Japanese candlesticks to look at significant swing lows and swing highs, right, as your potential targets. Okay, so I hope that this is clear so far, right? If you guys have any questions, please feel free to put them in the chat box, right? And if you guys want to take a look at the recording, right, we do have them on our YouTube channel as well, so you can take a look at them there, right? And yeah, we do have this on a bi-weekly basis, right? So if you guys would like to join the sessions, right, just a reminder that we have them on a bi-weekly basis. You can reach out to your account managers for them, right? Or even via the app, I believe. Okay, and last but not least, right, we do have a survey, right? So please help us to fill in the survey, right? Give us topics that you would like us to see so that we can incorporate them in our next webinar planning as well. So topics you'd like us to see or instruments you'd like us to cover. Okay, so feedback on today's session as well, what you like or dislike about the session and how we can improve from there. Right, so if there are no questions, that's what we have for today. Right, see that we don't have any questions on the chat. So if not, right, that's what we have for today. Right, thanks everyone and have a great trading week. We will catch you guys again the next week. Thank you, and we'll catch you guys again soon.